Alright guys, welcome back to another video. Um, this video will be without my face basically because there is some issue with the webcam. Alright, so we'll get it fixed soon. But obviously doesn't really matter a lot. We will continue with what we planned on discussing. So we will talk about volatility cycles. We'll discuss it in brief. We'll probably expand upon it in the next video. And before we start, I would like to tell you that if you have any problems with consistently following what I say, you can turn on the captions. All right, the captions will be available if you're watching. If you're watching just after it's released, it might not be available, uh, but in some time it will automatically get updated. So you can follow along the captions and also like the video. It helps with the algorithm. Share, comment, and all that stuff. It helps with the algorithm. It helps with the motivation to keep on making these. All right. So without wasting any more time, let's talk about volatility cycles. All right. So so price movement is basically a function of volatility. All right. So what does volatility? First of all, what does volatility mean? All right. A lot of people think that a range bound market is called a volatile market, but that's not the case at all. Volatility basically means the term volatility means the range of the candles. All right, so it means the range of the candles. If the candle ranges are bigger than normal, then it's a highly volatile market. If the candle ranges are smaller than your average range, then it's a less volatile market. Things will be much more stable on either side. All right, so if I take an example, this area is very less volatile, whereas this entire area right here, you see the candle ranges are huge. All right, so the volatility is also very much very high for that matter. All right, so so when do we, so how does price actually move? All right, price will move in a volatility cycle. Volatility will rise, and then volatility will fall down, and then it will rise again, and then it will fall down. So why does this actually happen? So let's take an example of a downtrend and an uptrend, right? Why does this actually play out? So you must have noticed when the market is going up, all stocks are not going up, all right, until the market is going up. It's forming a big candle in intraday, all right, a big up move candle. Usually you will see when the market is going up, it's going up in tiny candles like this, and when it's falling in bigger candles like this. So why does it happen? So let's say you have two or three sectors in the market which move the index. So on one day, if one sector breaks out, the index will go up and the sector will break out big, but the other two sectors are not breaking out. So it means that the index is not moving as much as this sector is moving, right? So the up move is small. But if the market continues to stay strong, in a few days' time, these sectors will also start to break out. So basically, they will also take the index up. But every time the index goes up, those candles will be small. All right. So this is the major pattern of an uptrending move, where you will see that all sectors are not moving together. Mostly, sometimes they might move together. Then you will see big candles in the index as well. But when the up move is very far up, you will see that all sectors are not moving together. All right. So whenever the up move happens, if it's happening in a concentrated manner, you will see that the index is moving up slowly. All right. So uh, but on the contrary, when the index is falling, you will see that almost all sectors fall together, right? Almost all sectors fall together. That is why you will see that the index is making bigger candles on the downside, because this move here involves all sectors moving down equally, or uh, more or less the same amount of same amount of percentage, right? Which is why you'll see big fall on the downside. But what happens after this big fall? What happens after this big fall? So So what happens is, so first of all, whenever this big fall is happening, the volatility is increasing here. So let's make a volatility curve. All right, then it will be much more clear. So this is your uh, let's talk about a volatility curve over time. So on this axis, you have time obviously, because there is no other parameter on the chart. You have price and time, and this is your volatility. So we are not talking about price and time here. We're talking about volatility. So the price can go down and volatility can go up. Price can go up, volatility can also go up. So it does not really depend on price movement. So we'll see. So let's say there's a big fall. So volatility will spike up. All right. So now what happens after a big fall? Price will either pull back in an equally big up move. All right, which means that the volatility will stay here because the candles are still big, right? Or price will go sideways here without really pulling back. That means the volatility will fall. If price goes back after a big up move, what is the next step? The next step is price will again go sideways, because price cannot just keep doing this, right? So price after a big up move, it will again go sideways to fall or maybe go up again. So in any of these situations, after a big move, price will tend to the range the range will tend to shrink back down. All right, so this is your phase of volatility contraction, no matter if the price goes up or down. Now when the range is, let's look at this example itself. So here, if you see, there was a big fall. All right, then price went up. In this area, the candles are still big, the range is quite big, and then what happens? The range gets smaller here. All right, range got smaller, so volatility came down. Then what happened again? There was an expansion, and then the range got big again. So again, volatility is going up again. All right, and then here what happened? There was some sort of a range. Price broke out and price started to break down again. So maybe volatility stayed on the upside here, but at the lows again, if you see, there is reduction in the range of prices again, and here the volatility will drop off again. All right, now again when it reaches a low point, when you see the candles get extremely small, again starts to expand. You see bigger candles start to show up here, so again it slowly starts to creep up again. All right, so in this manner, if you see any sort of price movement, it happens based on what sort of, you can expect what sort of price movement can happen here. All right, so if the volatility is already expanded, so instead of actually trying to trade it according to that the volatility cycle, you want to see what is the best point for you to take the trade. All right, the best point is obviously when the volatility starts to expand here, and this is what people basically call a breakout, because when will the volatility expand? It will expand when the price is starting to break out, right? So when, because the breakout candles, they break out from a range, so the candle is much bigger than the previous candles inside the range. So people will try to catch the breakout, but most people, what they do wrongly is they will buy too late into the breakout. So when you're buying too late into the breakout, you're buying somewhere above the middle point of this volatility cycle. All right, so when you're doing that, you are basically leaving out most of the move behind you. All right, so let's take an example here. When you are selling this breakdown, here, you are leaving most of the move behind you, because you have no idea how the move is actually starting out. All right, the move is starting out from this supply, it's not starting out from this breakout level. So this part of the volatility cycle, people will usually miss out on. All right, so that is a very, very important part, and you're buying here, and again, by the time you make some profit, you try to follow the trend, the cycle starts to drop off and you start seeing some sideways candles. Then when the another expansion phase comes about, it can pretty much go against you, against your trade itself. All right, so you never know that, right? Because you're basically, the second expansion phase basically means you are expecting a continuation move of your previous expansion move, right? That might not happen as well. All right, so So this is how this works out. So let's look at it in the current chart as well, and then we will end the video. We will discuss it in more examples, maybe in a live session soon. All right, so let's look at this phase in Bank Nifty. All right. So here, if you see, there is a breakout. There is a breakout. So I'm aware of this demand. So when price comes back to this demand, I am expecting it to form a range between this candle and this candle, because this is my range. So volatility is on the higher side here because of two big moves. So now I'm expecting some smaller candles, and they show up. Then I see that it's trying, that there's some supply coming in, and the range is expanding on the downside here. So now I'm expecting price to give me some sort of a volatility expansion soon, so I can look for shorts around the higher supply. Comes down to the demand, then it starts to contract here again, and today it has broken out. So if you don't get a nasty reaction from the supply, this can definitely continue on the upside. So understanding these cycles, it will immensely benefit you. All right, and take this video as an introduction. Try to spot these on stocks, because in stocks it will work even better. Let's take an example. Let's just take this example. All right, this is no stock recommendation. This is just an example. All right, so if you see the phases very clearly here, let's see. So this is your expansion, goes back up, and here is your contraction. Look at this range, starts to taper down. All right, then again expansion, and again you see some sort of a range contraction towards the end. Again you expand, you push back up, you contract again to break through this supply. Then again there's an expansion, there's a contraction, there's an expansion, contraction, expansion on the downside, contraction, and then expansion, contraction, and then expansion on the downside. So this is how it works. There is no secret to this. All right, this is how all stocks will move. Some might be more volatile depending on the participation, but this is mostly how all stocks move. So we'll stop this video here. Hopefully you learned something new, and please make sure that you like the video. You also share it with your friends and family, and I'll see you in the next one. Hopefully this was helpful. Have a good day.